Hey everyone, welcome back to Corporate Decoder. Today we're diving into Nuburu's latest 10K filing, and let me tell you, it's a wild ride. Think of it as a financial roller coaster with a few unexpected twists and turns. We're going to break down what all the numbers mean in plain English. Nuburu, for those who don't know, is a company that was focusing on high-power blue laser technology, but they've hit some serious turbulence, including a lender taking control of their patents. So how's this company trying to change their course? Let's find out. First, a quick note, this report contains forward-looking statements which are basically guesses about the future, so keep in mind that things can change. Let's start with the basics. Nuburu used to be all about developing these fancy blue laser systems for things like welding and 3D printing. However, they hit a major snag. Their lenders foreclosed on their patents. That basically means the bank took their core technology. This led to a shift in strategy. Now, Nuburu wants to focus on licensing their remaining know-how, particularly in the defense industry, and diversifying into other businesses. They previously shipped blue laser systems for applications like electric vehicle batteries and medical devices. Now, expect to see them focusing on the defense industry. To achieve their goals, Nuburu is making some major moves, planning to acquire controlling interests in a defense tech company that builds specialized vehicles, a software company focused on operational resilience, and other acquisitions in the future. And in light of the foreclosure, they're adapting their research and development to focus on strategic licensing and applications in the defense, including defense-related vehicle space. Their products are subject to regulations that govern their safe operation. In addition, they are working with US Department of Commerce, Bureau of Industry and Security to ensure export compliance. Looking at the risks section, let's talk about the elephant in the room. The company mentions the aggregate market value of the voting common stock held by non-affiliates, which is used in determining requirements. Now, time for the risk factors. It would be easier if they said risk alaka, as it contains the most important details, including going concern matters and other considerations. This is always a key section in these filings, so we need to pay close attention. One of the biggest red flags is that Nuburu has a history of losses and might not be able to turn a profit in the future. They also talk about their ability to obtain financing, which is crucial for their survival but not guaranteed. If they can't raise enough cash, they might not be able to meet their financial obligations or keep growing and developing. They have a rapid succession of strategic acquisitions, investments, and procurement arrangements that also may not work. If this were to occur, it would have significant negative consequences. We can also see risks around protecting intellectual property, which is even more important now that they lost the patent estate. It could make it hard to compete if others copy their technology. Speaking of intellectual property, Nuburu's secured lenders obtained their existing patent portfolio, which is clearly a big deal. This means that while they retain their trademarks, trade secrets, know-how, and other intellectual property rights, the former secured lenders may sue them for infringement if they believe Nuburu's participation in the laser industry is in violation of the patents they acquired through the foreclosure. There's a new standard item regarding cybersecurity breaches, and cybersecurity incidents is always mentioned by companies, which is very relevant and worth noting. Let's look at the next section where they state that they are a non-accelerated filler, smaller reporting company and emerging growth company. This matters because it affects how much information they need to share and how quickly. They also mention the aggregate market value of the voting common stock, which is used in determining their status as a smaller reporting company. Alright, now let's get to the heart of the matter, the financials. This section breaks down the company's financial performance. In a year, they only made $152,127 in revenue and a net loss of over $34.55 million. To put that in perspective, that's a loss of roughly 226 for every dollar they brought in. Revenue plummeted almost $2 million due to cost-cutting measures and employee furloughs. Research and development decreased by over $3.6 million, mainly from cost-cutting and restructuring to adapt to the change in strategy. General and administrative expenses also fell because compliance costs and professional fees went down after the business combination. They recorded a whopping $20.5 million loss on extinguishing debt, and we have seen why. Due to the debt burden the company had. In the near future, the company needs additional capital to finance its operations. In fact, given the lack of funding, management initiated measures designed to reduce costs, which included implementing a furlough of employees. Their cash position is very concerning. They had just $209 and $337 in cash and cash equivalents at the end of 2024 versus $2.1 million the year before. And now a word from our sponsor. Their lenders ended up holding an auction to sell off their patents due to these struggles. Their master agreement with Liquius that was signed last year will no longer be pursued as it was previously agreed. On February 19, 2025, the company entered into a commitment letter with Trumar Capital LLC to acquire through the acquisition of interests in TCE. TCE will involve the license of technology to expand the business within the defense sector as a result of the foreclosure. In more recent news, they entered into an agreement to jointly develop defense-related vehicles. To close out, here is a concerning risk. They may face infringement claims if their products violate third-party intellectual property rights or if they have to obtain licenses, and may not be able to obtain all necessary licenses on commercially reasonable terms. So what's our final take? Nuburu is trying to pivot after a major setback. They are pivoting into other areas due to their major setback, but that is not as easy to accomplish. Given the numbers above, it is an extremely speculative investment and would require a deep understanding of their industry to fully assess their situation and potential success, and the numbers have to start making sense. The best case scenario would have been having good finances and building this business. Thanks for watching. If you found this helpful, hit that like button, drop a comment, and subscribe for more insightful corporate deep dives. See you next time.